In this example, we're going to do PF5-45B, and basically we're going to do some adjusting entries. We're going to compile the adjusted trial balance and then finally put together the multi-step income statement. So let's get started with these adjusting entries. So interest revenue accrued $350. So we're going to have to recognize this interest revenue. So we will have interest revenue recognized, and we're accruing it, so it's going to be a receivable of $350. And then our memo is to accrue interest revenue. Okay. Salaries, selling, meaning we're going to have different types of basically operating costs, and so it's telling us that these are selling related operating costs for salaries, and we're going to accrue $2,200 of these expenses. So we're basically going to have a salary expense selling as opposed to administrative, and we're also going to have salaries payable $2,200. Okay, now we have our depreciation. So this is going to be equipment for our administrative part of our business. So we're going to, again, have depreciation expense for administrative equipment. And we're going to have accrued depreciation for equipment. And it's going to be $1,310. And now we have interest expense, so we're going to have interest expense, and it's accrued, so we have interest payable. Because remember, these are all adjusting entries, there's no cash involved. We're just doing these at the end of our period, October 31st. So okay, so it's saying that our inventory balance should be 45,100. So let's see what the unadjusted trial balance says. It says that it is 45,170. So it looks like we have a cost of goods sold, shrinkage, stolen items, whatever it is. We need to expense cost of goods sold by this $70 difference and reduce our inventory balance by $70. So you see how I got this? We have our unadjusted trial balance is 45,170, but when we actually did the count, it was only 45,100. So there's a $70 difference in that the physical count was $70 lower than what we're having in our unadjusted trial balance. So we need to get our unadjusted trial balance merchandise inventory to reflect the physical count. So we're reducing it with this adjustment. And so this is for inventory shrinkage. And then finally, Turtle estimates that approximately $7,000 of merchandise sold will be returned with a cost of $4,200. So to basically set up the estimates for our returned items, we have to do two parts of this. So the first, it's saying prepare the entry for the estimated refunds. So basically, we have to reduce our sales revenue by this amount of our estimate for how much is going to be returned. So we're going to basically reduce our sales revenue, and we're going to basically create a liability called refunds payable. So it could be that you have a estimated sales returns account, but I think in the book it wants us just to simply debit sales revenue to account for the estimate of returns. So okay, so that's for the refunds part. The amount of a refund is when someone pays you for an item, you're going to have to give them that same amount back. So the refund is related to the sales price of the items. Now we have to estimate the return of the items back into inventory. So that's going to be reflected in our cost of the inventory. So the second part of it is basically we're going to have to reduce our cost of goods sold because we're assuming that some of it will come back, and so our cost of goods sold, if we didn't estimate for the returns, would be overstated because we're basically saying some of the stuff that we sold is going to come back. So we want to basically reserve for that by not overstating our cost of goods sold and kind of setting up a account to capture the returns based on our estimate. So we want to reduce our cost of goods sold by this $4,200, and we want to also set up a estimated returns inventory, which is going to be the same amount. And this is basically an asset. It's a debit normal, and as we basically actually get returns, we will reintroduce that inventory back into our actual account for inventory and reduce this estimate for the returns. So this is simply a accounting methodology to make sure our cost of goods sold is not overstated based on our estimate for returns. Oh, forgot to have the memo. Okay. Okay, so now we're going to do our adjusted trial balance. So let's start with cash, unaffected by all of our adjustments. Let's see what this does. Okay, so this is kind of a snapshot of all the adjustments that we did. Oops. Oh, there we go. Okay, so let's move on to the next one, accounts receivable. And we see here that accounts receivable was not really affected by any of these adjustments. So it should be the same. Merchandise inventory was affected by, let's see, this one, $70 of shrinkage. So okay, so we have 45,170 minus 70 is 45,100. And I'm going to do something a little unorthodox. Let's see how this is going to respond. But basically, let's add in our estimate for the returns for inventory. And that was 4,200 debit. Okay. We also have our interest receivable, or sorry, yes, interest receivable we had here of 350. We have equipment of 131,100. And then we have our accumulated depreciation for equipment. And so there was an adjustment here. So the unadjusted balance is 37,400, and then we took an additional expense of 1,310. So when you add those together, you get 38,710. Sorry, it's a little hard to see. Okay. And let's see if we're missing any other assets here. Oh, sorry, this is 42. Okay, so I think we're okay with our assets. So now let's move on to liabilities. So we have, starting on our unadjusted, this accounts payable. We have our refunds payable of 7,000. We have this unearned revenue. Anything else? Interest payable. Of 1,000. So this is a little disorganized. I think if you had a worksheet or some other way to organize this, it would be a little cleaner. I'm kind of doing this ad hoc. So I recommend that you kind of do some T counts or some way to organize this better, because the way I'm doing it is very prone to mistake, because you may miss something here and not adequately add or subtract it to your unadjusted trial balance. So basically, don't exactly do what I'm doing. Try to be a little more organized, or else you risk making a mistake. So let's continue on. Any other liabilities? I don't see any. So actually, salaries payable is one that we need to add. Okay, and I think that pretty much covers the adjustments and the liabilities listed here. So now let's go to common stock. And retained earnings, which are both unaffected by our adjusting process. Okay, and then dividends, also unaffected by the adjusting process. Again, keep in mind the adjusting process is different than the closing process. After we've done our adjusted trial balance, we've made our financial statements, then the retained earnings in the post-closing trial balance will change. The dividends will go to zero. All the revenues and expenses will go to zero. But for now, the common stock and retained earnings are unaffected by any of these adjustments. So this is a precursor to us making our financial statements. So now sales revenue did have some effect from our adjustments. So let's see what they were. So our unadjusted balance was 289,750. And so if we look here, we had, in one place, we had a debit of 7,000. So we're going to have to reduce this by 7,000. And then we also, yeah, so I believe that's it. So we basically have to take this number and subtract 7,000 since it's a credit balance. and we hit it with a debit here. So that is $282,750. We also have another revenue, this interest revenue that we need to add. And I think for revenues, we should be good. Okay. Now let's continue on with our expenses. So salary expense, we have selling. And so we have our unadjusted balance of $25,700, but then we also have this adjustment of $2,200 that we have to add. So again, this is a debit, this is a debit balance, so we have to add them together. It's $27,900. Then we have rent expense for selling. We have salary expense for administration, which is unaffected. And we have utility expense, administrative. And then we have to add our depreciation expense that we took here, 1,310. And of course our most significant expense, which is cost of goods sold. So this was affected by a couple of our adjustments. So we start off with 145,000. And then we had this adjustment, this debit of $70 for our shrinkage. So we have to add that to our debit balance for cost of goods sold because this was also debit. And then we also had this credit of 4,200, so we need to subtract that. So that gives us a balance of 140,870. And so now we basically, I think we have everything. Oh, do we have interest expense? No, we don't. So we have our interest payable, but we need to add our interest expense, 1,000. So now let's add up all the debits and all the credits and make sure that they balance. Okay, so I think I'm missing some accounts. So for one, I don't know if this is going to ding me for getting this out of order, but we need office supplies, which I missed, 6,400. And then I missed this sales discount forfeited, 250. And I think that's it. So I think that adds up to, oh, and one more. This notes payable. Of 44,000. And so according to my calculations, this should be 466,330. 466,330. Let's see. Okay. Okay, so now finally let's do the multi-step income statement. So we have at the top net sales revenue, and then we're going to have less sales discounts forfeited. So we have 28750, or sorry, 282750 less 250. And that's going to give us our sorry, I'm mistaken. This is actually cost of goods sold. 14870. And that's going to give us our gross profit. Of 141,880. Okay. So now let's go drop down into our operating expenses. So we'll start with our selling expenses first. And so if we look up here, we have salaries and rent for selling. Oops. And then we'll have our administrative expenses. So we look back up here. We have salary and utility and depreciation. This will take a little bit of planning. You saw 3 slots here, and you have 3 administrative. So if you had done administrative up front here on top, it would not have worked out. So you have to kind of do a little bit of experimentation and planning. It's a quirk of using the software, unfortunately, but hopefully using the book as your guidance, how they set up the income statements, you should be able to figure out what goes where. And this is our total administrative expense. And we'll get our total operating expenses by adding up these two. And then when we subtract our gross profit by our total operating expense, we'll get our operating income. Okay, and now we're going to have other income and expense items. So what did we have? We have our sales forfeited. Sorry, sales discounts forfeited. We had some interest expense. We also had some interest revenue. And I think that should be pretty much it. And so when we add those in, I believe this was 250, 350, no, 250, 350, and 1,000 for the expense. And we're adding sales discount forfeited because it's basically sales discounts that we offered to our customers but they didn't take, so it's kind of extra revenue. And so after we factor all this in, we subtract 400 from our operating income and we get 30470. So let's see if this is going to check out. Oh. Okay, so I just wrote 80870 instead of 80470 and that worked. So it looks like we're good on this problem.